All right, every single day we trust banks with our money. But how do we really know if they're healthy? Well, in this explainer, we're going to give them a full checkup.
You see those headlines about financial crises, and it can be pretty unsettling, right? So today, we're going to pull back the curtain and show you exactly how the experts, the regulators and analysts, figure out if a bank is actually safe and sound.
Think of it like a medical checkup. Seriously, the experts have this really powerful but pretty simple framework they use to check a bank's vital signs. The whole point is to diagnose its financial health, to make sure it's operating safely and not, putting our money at risk. And that framework? It's called the CAMEL system. Yeah, like the animal. It's actually an acronym for the 5 key vital signs of a bank's health. It was first rolled out in the US back in 1979 to standardize how they check on banks, and believe it or not, it's still the gold standard today. So let's break it down. Okay, so let's start with the first 2 letters, C for capital and A for asset quality. These two, they get right to the heart of it. They tell you about a bank's core financial strength and how good it is at its main job, which is, of course, making loans. So, what is bank capital? Well, the easiest way to think about it is as a financial shock absorber. It's this cushion, this buffer that soaks up any unexpected losses. It's the wall that stands between bad investments and your money. It's pretty much the most important line of defense when things go wrong.
And this right here really shows you how it works. A healthy bank has a lot of capital, a really thick cushion. It can take some pretty big hits and still be fine. But a risky bank, it's got this tiny, thin cushion. That makes it super vulnerable. I mean, even a small loss could wipe out its capital completely. And poof, it's insolvent. But here's the thing, that capital cushion is only as good as the assets it's protecting. And that brings us right to the A in CAMEL, asset quality. Look, a bank's main assets are the loans it makes. Mortgages, business loans. So its health is almost entirely tied to whether or not people are paying those loans back.
And this is no joke. Poor asset quality is hands down the biggest reason banks fail. When that red slice of at-risk loans starts getting bigger, it just eats away at the bank's profits. And even worse, it starts destroying that capital cushion we were just talking about. That threatens the bank's very existence.
All right, so we've looked at the financial foundation. Now our CAMEL checkup moves on to M for management and E for earnings. So this part is all about the people in charge, and of course, the money the bank is actually making.
Now, the M for management is probably the trickiest part of the whole system. You can't just plug it into a formula. Analysts have to make a judgment call here. They're looking at the leadership skill, their strategy, their whole attitude towards risk. Are these people responsible captains of the ship, or are they out there making reckless bets with other people's money? And that brings us to earnings, which is super interesting because banks make money in a really different way than, say, a company that sells shoes. A regular company makes money from sales. But a bank's profit engine is something called the interest rate spread. Basically, they pay you a low interest rate on your deposits. Then they lend that money out at a higher rate. That little difference, that spread, that's their bread and butter. So when analysts look at a bank's earnings, they're not just looking for a big number. The key here is quality. They want to see stable, sustainable profits over time. A huge profit in one quarter that came from some crazy risky bet, that's not going to impress anyone. What they want is consistency, profits that are strong enough to cover losses and help build up that all-important capital cushion for the long run. Okay, we've made it to the last letter in CAMEL. The final vital sign in our checkup is L for liquidity. And this one is simple but absolutely critical. Can the bank meet its cash obligations, like right now? And I can't stress this enough. Liquidity is everything. A bank can look amazing on paper, with great assets and big profits, but if it runs out of actual cash to pay people what it owes them, it can fail, literally overnight. You can think of liquidity as the oxygen a bank breathes. Without it, it just can't survive, especially when people start to panic. This quote from It's a Wonderful Life just nails the core challenge here. A bank doesn't just stick your money in a big safe in the back. No, it lends it out. Just like George Bailey explained, your money's in Joe's house. And you know what? That system works beautifully until everyone shows up at once demanding their cash back. That's when you have a big problem. So, to manage this huge risk, banks have to be really smart about where their funding comes from. Having lots of stable deposits from regular folks like you and me, that's the gold standard. That money tends to stick around. But if a bank is relying heavily on borrowing from other financial institutions, what we call the money markets, that's a huge red flag. Why? because that kind of funding can disappear in the blink of an eye the second there's a hint of trouble. Okay, so there you have it. The CAMEL system is how we get the diagnosis for a single bank. But what about the bigger picture? Let's zoom out and look at the treatment plan that's designed to keep the entire system healthy. It really comes down to 3 layers of safety. The first line of defense is the bank itself, its own rules and risk management culture. Then you have the second layer, the official regulations set by the government. And finally, if all else fails, you have the government backstop, things like deposit insurance, which is there to keep people confident in the system and prevent a total meltdown. And these rules aren't set in stone. Not at all. They've changed a lot over the years, usually right after a big crisis exposes a weakness. The first big international agreement, the Basel Accord, came in 1988 to standardize capital rules. Then, after the massive 2008 crisis, regulators came up with Basel III, which demanded even more capital, and for the very first time, put in place global rules for liquidity. So why does all this matter so much? Because the whole point of this entire system, the checkups, the regulations, is to manage something called systemic risk. And that's the absolute nightmare scenario. It's the danger that one bank failing could trigger a domino effect, taking down other banks and then the entire financial system and the whole economy with it. So now you've got the toolkit. The next time you see those scary headlines about a bank in trouble, you can look right past the panic and start asking the smart questions. Is this a C problem, not enough capital, or is it an L problem, a liquidity crisis? Knowing these 5 vital signs is your key to making sense of it all. So the system is designed to be safe, but we know crises still happen. The real question is, the next time you hear about turmoil, which vital sign will you check first?